Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Sorry about that.
Welcome, everyone. This is your host, Steve Meisinger, and I'm pleased that we have Jack Crooks with us. Jack is the president of Black Swan Capital, and Jack understands currencies way better than most. He is the president of Black Swan Trading, so you can go to blackswantrading.com to learn more about his services. Without further ado, I want to introduce Jack Crooks. Jack, how are you?
Hey, Steve. Great. Thanks. Sorry, everybody. Had a little system malfunction there. Thanks for having me, Steve.
Pleasure's mine.
I'm just going to go through really just the setup of the macro setup as we see it that we've shared with our customers. Different scenarios that are playing out that we think can play out that are still in play for 2011, that's for sure. And just going to try and go through some of these things, not in too much detail, and try and save some time at the end for your questions. Hopefully you have some questions at the end. Be happy to stay on the line and answer as many as we can. So please don't hesitate to type those questions in as we go along. So let me get started. There's our various disclaimers. Dollar Smile. This is something that we've shared before. If you've seen some of our webinars and been with us, reading some of our research papers, I guess you could say. This comes from, this wasn't original. We stole this from Morgan Stanley currency analyst, who is no longer with Morgan Stanley, but was very, very good. And he put this out a number of years ago. And it's a very simple format or framework to analyze global macro as it relates to the dollar. So in effect, there were three different buckets to think of. Over here on the left, and let me grab my pen or pencil here. On the left, the dollar goes up on global risk. And we know that, and we've seen that with the credit crunch. Major global risk in the world, the dollar goes up because people hide in the U.S. market. We're talking about major systemic global situations. Even if the U.S. is ugly, the dollar goes up because people come and hide in the capital markets. In that case, we have the scenario of sell the Australian dollar or commodity currencies. The emerging markets get hit, and the euro would get hit on this scenario. The euro's been acting pretty well on risk of late, but in general, major systemic risk problems, especially if it rolls out of Europe, it's going to hit the euro. The other bucket is this area of muddle through, and it says the dollar goes down, and Smile is here. So we have 1, 2, down, and 3, this one up. Okay, so we're in here and muddle through. And muddle through just says that the U.S. Fed continues to keep interest rates low, uses the dollar basically as a fuel to lubricate the global economy, which with QE2, that's exactly what Bernanke had in mind. QE3 is kind of more of the same, although there's some questions as to the one, the efficacy for sure, and two, the reasoning for QE2. We'll get into that a bit as we go through. But anyway, if the U.S. just muddles through and doesn't outgrow the rest of the world, its interest yields are very, very low. The dollar, in effect, almost a carry trade currency, but being spit out. U.S. investors move more and more money offshore for higher yields, higher returns, higher growth. The U.S. dollar just fades in this muddle through scenario, and we're generally in that scenario to a degree. The interesting thing is, though, the U.S. is actually still growing at the moment faster than Europe, even though the dollar is falling slowly but surely in more of a muddle through scenario. And in this scenario, buy the Australian dollar, Canadian dollar, commodity currencies, commodities in general, emerging markets, we have Singapore dollar, and gold, of course, does well in this liquidity type of environment in which it's not competing with the U.S. dollar on interest rates. And the third scenario is this idea of U.S. growth. And when you think of U.S. growth, you have to think of this term relative. We don't think any of the developed world economies are going to break any records here given the debt overhang. But on a relative basis, we think the U.S., if it gets going, and of course there's a big if, can outgrow Europe. It is already growing faster than Europe, can grow faster than the UK, can grow faster than Japan. So the major developed world countries, such as those three, I guess you would, as you can compare them against the relative currencies, the euro, pound, and yen, for example. The U.S., we think, can and will outgrow if growth gets going. Australia, Canada are two different stories. Those commodity currencies are obviously those countries we think will continue to grow fine if the background is such that the U.S. is growing and can outgrow but will outgrow the other three. In that case, the U.S. dollar gets some yield support and it gets some growth, which means we want to be long U.S. dollar, long emerging market currencies against the euro, paired against the euro, and generally still favorable with the commodity currencies. But with the U.S. dollar so oversold in here, if we finally start to get a move in terms of growth and yield, we think for a while the U.S. will outperform the commodity currencies just by the fact that it just looks so cheap to us. But sooner or later, if this scenario is in play, if the U.S. demand is intact, then commodity currencies will be doing just fine. So that's the general scenario to try and think of the world in those three buckets, and I think it's a good framework to help us out. You've heard a lot about these currency wars, and we put this chart together just to try and give you some framework of what this looks like. We're really in that scenario of beggar thy neighbor. Everybody's trying to beggar thy neighbor, that old term, which relates to, we're going to depreciate our currency and try and increase, our exports. The problem is we're in a world in which demand is not that great, and everybody's fighting for a very, very small pie of demand out there. So we tried to break it down on the four major players that really represent the global currency war, so to speak. Emerging markets here in the yellow is kind of put in one bucket. Of course, the two big players are U.S. and China. And the U.S. implicitly, through its weak monetary policy, massive fiscal spending, is implicitly pushing down the U.S. dollar from their mercantile advantage. China, we know, is explicitly manipulating its currency. I don't think there's any doubt about it. If you look at the reserves, you look at what they're continued undervalue and suppression of interest rates. Most economists think 20 to 50% undervalued the Chinese currency is, and of course we know the reason why. China has to keep those exports going because that's the way their economy is structured. Germany is an interesting story. Germany meaning the euro, representing the euro, is really an area where they're not suppressing the currency. It's one of the few areas, and of course that's become the pressure valve because as the U.S. dollar falls, China, its currency falls as it's tied and pegged to the U.S. dollar. Both fall relative to the euro in Germany, and that's been taking that pressure valve. But Germany hasn't minded it much because they have a captive market, and they basically manipulate the market because they own the Eurozone. And that's the reason Germany decided to go to the D-mark a long time ago. They knew they would have a captive market in the Eurozone, and the currency, increasing currency wouldn't hurt them. Germany is also benefiting tremendously from exports of high-quality machine goods to China that are less, at this point, on a relative competitive basis, not really currency-driven, given the demand that's needed by emerging markets for these machine tools and the demand for China to buy these machine tools so they can copy them and reverse engineer them and sooner or later put Germany out of business. So at the moment, Germany is not being hurt by the rising currency, but this will change. In the emerging markets, they're both explicitly and implicitly trying to weaken their currency. The emerging markets tend to want it all. They want all the money coming in. They want to keep interest rates low, and they want to have inflation to be low at the same time. Well, they can't have all three of those things. And you're starting to see them hike interest rates. But you can't. If you're going to hike interest rates, you're going to tend to draw a little more money in. So if they try and suppress their currency, it leads to problems. There's always problems on the other side of the fence. So if emerging markets in general were to let their currencies just float according to the amount of money coming in, they'd be running up and up and up kind of like Brazil has done, and you're starting to see them in the other emerging markets. But you're starting to see Brazil putting more and more capital controls on because of the huge move that we've seen in their currency. And you can't really blame them because the emerging markets in general are fighting for this pie, and they're fighting against a China which suppresses their currency completely and doesn't let their currency move. If China let its currency appreciate, then the emerging markets, I think, would be able to do the same. It would take some pressure off of them. So China really is kind of the kicker here of putting the competitive pressure on the emerging markets that compete for this Western demand for goods and resources. China, of course, is also a big demand base for a lot of the emerging markets and growing that way. So it's kind of a double-edged sword for the emerging markets. They don't want to criticize China too much, although they're the source of the problem, but they're also becoming a greater and greater source of the demand, so they have to be careful. So there's really this whole idea. They're fighting for a smaller and smaller piece of this export pie, and everybody's trying to suppress their currencies, but everybody can't, because sooner or later this game just ends very, very badly. Where it ends in trade tariffs and everything else, and trade barriers and trade wars is where it ends. The U.S. can't continue to take all these goods and run these giant current account deficits. I mean, they were able to do in times when they were a little more financially secure, but of course we know those times have gone. So the pressure's building politically out there for this game, and it really does center really on China. Really is the linchpin here. In terms of risk, and again, we tried to break these down. We looked at the major three in the world and how they impact the global economy, and we looked at them as linkages, and it's fascinating how closely linked really these three major economies are. You can think of Germany representing the euro, or what's working in the eurozone. There's also Netherlands and Finland in there that are, of course, doing pretty well too. The northern tier of Europe, but Germany is the driver, of course. So this represents Europe, so to speak. But if we had a look and we had to define, what is the biggest driver in the world, and if it goes away, everybody's in trouble. It's U.S. demand. U.S. still puts out $10 trillion in global demand. I think it's like over 50% of the global demand out there. So as if we go back again and think of this export pie here, the U.S. represents half of this pie in terms of global demand that people are fighting for exports. And of course, the U.S. wants to export in its own right. But U.S. demand is number one, is really number one. So if U.S. demand goes away, China is in big trouble. They still need us to export, despite knowing that the problem is their dependence on us. It's very, very difficult for them to get away from that model. From an export standpoint, their exports may slow, but what's happening is they're adding more and more direct investment into the economy. So you have exports and investment driving GDP growth, and the consumer is becoming less and less of total GDP. Which becomes more and more dangerous for China because they can't continue this investment because they have massive bubbles inside their economy, and they can't continue to subsidize exports and try and let everybody in the world take the exports because of everybody's running out of patience because of what we just showed, fighting for that that demand pie out there. So they're really still highly dependent on U.S. demand. So if U.S. demand goes away, China is in trouble, and if China goes away, the Eurozone's in huge trouble because most all of Germany's major growth is coming from China. Massive amount of exports now. Germany is now running a current account surplus against China. So the big benefit to the Eurozone comes from China, keeping Germany very, very solvent. If Germany loses its solvency, and I don't mean that from they're going to go bankrupt tomorrow, but if their growth slows in a major way, you can bet they'd have less and less incentive to support what's going on throughout the entire Eurozone and support these periphery countries. Already there's a massive amount of political protests inside Germany, even though Germany is benefiting from the Eurozone still because of its captive exports. The German people are sick of, the taxpayers are really tired of it. So if their growth were to slow, that political pressure would hike up tremendously, and you would see Germany would pull back, we think, in a major way from subsidizing the Eurozone. So these are really the key linkages going on. You've noticed that lately, at least recently, and a lot of it was oil, but in general, U.S. Current account deficit has increased again, meaning we're taking on more and more Chinese goods, even though politically it looked like it was going to be very, very messy to do that. But that seems to be toned down a bit, and even you also notice that the U.S. about a month and a half ago, I think it was, put out its report on currency manipulators, and of course China should have been on it, but they gave them a pass. So this idea that they're kind of stepping back and giving China a little breathing room in here, in a sense, knowing that if they were to get if the U.S. legislators were to get nasty with China in here, it would probably be pretty bad for the global economy, because we're still at a point in which it's still a little bit tenuous growth in the world economies, and some type of trade war would make this very, very ugly. So at the moment, U.S. is slowly improving, keeping the demand engine alive. China is fighting the dual problem of rising social tensions, somewhat related to rising food prices, and yet at the same time they have to maintain a certain amount of liquidity to keep their GDP growth up. So they have they're in quite a box, and I'll share that with you in the next slide. Really part of their problem, their treadmill, so to speak. And Germany is still highly dependent on China staying flush and keeping hope alive, so to speak. So the key risks are, if U.S. demand falls off the table, it just reverberates right through the world economy, hits China in a very, very big way, and then comes in and hammers Germany. So you can see, if this stays on track, I think the world economy stays on track. If this gets in trouble, obviously, the rest of the gang's in big trouble. Now, one of these could fall off, and obviously it may not impact the U.S. as badly. But needless to say, if we have a problem in the Eurozone, some type of banking problem, systemic risk, it'll flow and impact the others, but not to the degree that if we had it coming right out of the U.S. in terms of the impact on the global economy. So just to keep it in mind in terms of importance, too, and linkages. This is a look at, we put this together, and I'll try and explain this chart, but you may take some time and just read through it on your own if you can, and think about these things. And there's a lot here, and we could probably spend a whole seminar on this. But one of the things that China has done for many, many years is suppress its interest rates, and which leads to massive amount of capital misallocation. And that has to come to roost. I mean, you can only hide from that so long. There's like a day of reckoning at some point, but they've had the ability, because of the growth, in order to hide a lot of these warts. And a lot of these warts are hidden in the non-performing loans on their banks, which are basically conduits from the Central Committee just to run loans through. They're not really banks in the sense that they have the efficiency and they allocate capital based on economics. They mostly allocate capital based on political will and a lot of corruption. Not to say that there isn't some economic, obviously there's a lot of economic reasoning, but in general they're not run like our banks, which allocate the capital according to economic efficiency and payback and everything else. So it creates a nasty situation. And one of the problems that China had in the early 2000s, they had a non-performing loan problem and a banking crisis. And people say, well, they just skated right through it. Well, it was in a period in which we had a massive amount of global growth from 2000 to 2007, as we know, in the global economy. But it also led to a pushing down in household wealth. China subsidized interest rates in the banking sector, subsidized basically for the banks in a very big way. And when they suppress interest rates and they force savings from the household sector, it just transfers wealth from the housing sector to the banking sector. And that's what that non-performing loan problem was. It was a transfer of wealth out of the hands of Chinese consumers. So in effect, it pushed that consumer penetration of GDP down further and further. And now it's about 35% of GDP, which is extremely low for an economy their size. It's off the charts low. The U.S., for example, is 70% consumption. So it's a big problem, and part of the problem is is covering up those non-performing loans in the early 2000s that did hamper their economy, but it wasn't seen. So now, we've had that massive transfer of wealth, and a similar thing's happening now as consumer penetration in terms of the size of the economy falls and falls with relatively low interest rates. It means that you have relatively low consumer demand, and you keep going up the ladder here, which means what does China have to do to keep GDP growth? If you have relatively low consumer demand, given the size of your economy, well, you have to make more investments and you have to make more exports. Exactly the model of the misallocation of capital that has created this problem, they're forced to continue to do. So even though they have this inflationary problem and they have, food prices, soaring, so to speak, we don't know officially, but unofficially they're way, way up there, to say the least. They're trying to put a lid on that, but at the same token, they have to keep liquidity forced into investments and forced into subsidizing exports, because this area just isn't getting it. They're not going to get growth out of they're not going to transition to a consumer economy for a very, very long time. And in fact, there's a massive amount of blowback from people that are doing very, very well, the princelings and those in power that have these industrial corporations that very much like this model and have enriched themselves on the model. There's also people, in the at the Politburo, so to speak, that know this model has to change, but are being outvoted, so to speak, by the power that's in play. So there's going to be blowback as China tries to make this transition, and that's why it's not going to be simple for them. It's not going to be simple economically, and it's not going to be simple politically. So what's happening is they're basically on this treadmill of continuing to force liquidity into industries where you already have massive overcapacity. You've seen it in their housing market. We've seen it in their shopping centers. We see it in aluminum, cement, steel, all these industries which already have huge overcapacity, but they're on this treadmill, so to speak. And if the U.S. were to fall off the cliff, this exports gets hit, they got to drive more and more investments internally, which creates more and more credit bubbles, which leads to more and more inflation, which is already a problem they're trying to deal with, which is going to lead to huge trade friction, continued trade frictions, and we've talked about excess capacity. So this is kind of why we call this the China treadmill, virtuous because it drives growth, but is soon to turn vicious and could turn vicious in a big way. And I think that's why the U.S. has kind of stepped back from putting the screws to China. They understand, China is in this problem. China admits it. Key Chinese economists know this is the problem. They're not stupid, but by any means. But this is why they say they need time to make the transition, and it is true. So, but we'll just we'll find out whether or not they're going to get the time. And the way they're going to get the time is if U.S. demand returns, U.S. legislators don't start putting up trade tariffs, and the patience remains. And that's another question. If the U.S. economy starts to turn down again, you not only have the pressure of declining export markets for them coming from the U.S., you'll also at the same time, it'll self-reinforce the U.S. call for tariffs against China. So this is why from a global macro standpoint, things can look fine, but they can turn precarious right away if that lead driver here, if this gets in trouble, it can all self-reinforce the problems in China. So that's what this chart kind of interacts with the prior one. And I also wanted to show you this chart, which just shows the red line represents the Shanghai Stock Index, and as you can see, it had, if we even go back, it's made a pretty tight correlation with copper. This black line is copper, and now we're seeing a pretty big divergence in here between the two. So it's something we're watching. We think copper is really a bit overplayed. John Ross does the analysis on the commodities here, and although we're not saying that the game is over, it looks like as China tries to suppress interest rates, raise reserve requirements, raises interest rates, suppress the inflation rate, you're going to see some slowdown in here. And again, they admit it. So we think it may be a time for maybe a turnover in some of the commodities markets, which we think may pressure some of the commodity currencies going forward in here.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.